On today's episode, we are going to take a look at two new growth stocks. Both of these stocks are companies that are in markets that are very disruptive or very bullish at the current state right now. The first one is a company that's trying to disrupt the traditional educational system for higher education like colleges and universities, and is trying to move everything online. The second company is one that's very big in the gaming industry right now. But even though it is in the gaming industry and it is big, it hasn't had that same amount of noise that the other companies have seen. So this episode is going to be breaking down into following. We're going to take a look at both these companies, and for each company, we're going to take a look at their current markets, the markets they're hitting, and how they're hitting those markets, the expected earnings growth, and their balance sheet to try to make sure that these companies are both businesses that have enough cash right now to be able to survive during bad times. And like always, if you are new to my channel, if you are a long-term investor, if you want to learn about growth stocks, make sure to hit the subscribe button. And to all my returning viewers, thank you so much for the support. If you guys ever want to get in contact with me, you can find me on the YouTube comments, you can find me on Twitter, you can find me on Twitch, on my weekly newsletter, on my free Discord channel. But like I said, all this information is free, and all of these are just my opinions and should not be taken as advice because I am not a professional. So make sure to talk to a professional before making any financial decisions. And both these companies are actually being bought out right now by ARK Investment. And if you guys follow ARK Investment, they are a firm that really focuses on disruptive market. So to see a company like them purchasing them right now kind of adds a bullish scenario to both. All right, so let's start off with the first business. And this is the one that's trying to disrupt the overall educational system, mainly with that higher educational system like I was talking about, colleges and universities. And that company is TWOU, ticker TWOU, and it currently has a market cap of about $3 billion, right? So let's try to understand what TWOU does. And I'm pretty sure that's how you pronounce the company. But like I said, remember the ticker is TWOU. So what I ended up doing is first we're going to take a look at their most recent earnings and just take a look at some highlights to understand what this company does and how it collects money. Their most recent earnings was their second quarter of 2020, which was shown July 30th of 2020. So about almost 2 months ago. But remember, as a long-term investor, even 2 months old information of our earnings is still relatively new, right? As a long-term investor, you're looking to invest for 3, 4, 5 years. So even a quarterly news that was just 2 months ago can still help show the overall effects of the company right now. Fundamentals don't change that much during 2 months. So it's still an important information to use. And right now, TWOU is partner and trusted brand steward to 75 of the world's top university. Here we see universities like Columbia Engineering, we see Yale, we see, what else do we see here? We see Penn State, we see University of London, Manchester. So these are some big schools right now they are currently working with. And this is also, they have RIT, Rutgers, the Ohio State University. And to me, it's always important to see MIT is here. Michigan State University is also here. So they have big names right now as partnerships. So it's pretty impressive to see these big names out here. So what do they offer? Let's try to understand more about the company. So like we mentioned, this company's clients are those higher educational institutions, and it provides them with some form of cloud-based SaaS program. So right, SaaS is a software as a service platform to allow coursework design, the infrastructure support, and capital. So it's not like TWOU develops the courses for, let's say, Penn State. Penn State already has the courses to create those online educational system. What they end up doing more is providing like the overall infrastructure so Penn State can bring in their classes online. And this saves time, right? Because if it wasn't for this, then all these educations, all these institutions would have to create their own form of platform or their own form of infrastructure and start their way up and build that before even being able to put their education in them. So 2U comes here, so they're like, all right, we already developed a system where we can work with you into adding your educational within our platform and to make it much easier for you to offer these forms of educations to your students. So now let's take a look at this company's most recent growth. So in their most recent earnings, they saw revenue growth of 35% compared to the same time last year. This was organic growth of 18%. And what do they mean organic growth? Recently, 2U just did an acquisition with Trilogy. Trilogy was also another platform that did some form of educational, of a very similar system to what 2U does, but more in the shorter time span. So for like those boot camps and stuff like that, that's what Trilogy did. So by 2U adding Trilogy to them, it helped them expand the type of products they can offer and the different types of programs they can do to the institutions. And this is what they called alternative credentials, right? You have your higher, and we can see it here in this chart right here. They have two segments when they report their revenue. They have their graduate program, and here is your standard certificates that you go to your college for, where you have your undergraduate degrees, you have your graduate degrees, and you also have some form of professional certificates. Then they have alternative credits. Alternative credentials are like boot camps, course stacks, or short courses. And this acquisition of Trilogy helps them really add on into this alternative credentials. I could be mistaken, but I believe the biggest impact was in those boot camps that Trilogy acquisition helped out. So their graduate program revenue was up 14% compared to the same time last year. Their alternative credential revenue was up 97%. So we can see this, on this quarter, they collected $182 million of revenue. Out of that 182, 115 came from graduates. So that's the biggest portion. 67 came from alternative credentials. But remember, that one's growing over 97%. All right, so now let's take a look at 2U's future growth. So here we can see they are expected to grow their revenue in the upcoming 3 years, 14.1% on average annually. So this doesn't mean every 3 years from now on is going to grow 14.1. This year might be a lot bigger. It could be like 30. The next year could be like 15. And the year after that could be like 5. My math could be wrong. But on average, within 3 years, it's about 14.1%. That's faster than the industry, and that's faster than the market. This company is also, and 14.1%, most of the investors that I follow are looking for a 15% annual growth on average for the upcoming years. So 14.1% is very close to that. And many people will consider this a little bit closer to a high growth stock. Not there yet, but it's definitely a growth stock to say the least. They are also expected to grow their earnings in the upcoming years at 17.3%. So a few things we're going to take a look at is, let me talk about one. We looked at the markets 2U hits, and to me, it is a very bullish market. And I do believe the online educational is one that's going to continue to grow. Right now, for example, I do a lot of my learning through online courses, but I look for them to be backed up by higher educational systems or institutions that are very strong. So 2U works with those institutions to allow to bring out that. So I do believe this is a market that's going to continue to grow. Unfortunately, right now, it seems that this market is not one that is going to be profitable within the next 3 years. And right now, as they are software as a service product, they're probably spending a lot of money trying to acquire these customers. But these are usually one-time acquisitions. What are the chances of creating an infrastructure, putting all your educational system in there, and then leaving that infrastructure? So these, I believe, are ones that once you get your customers, they're pretty much hooked into you. And as they continue to get into bigger schools, into more schools, that earnings is going to continue to grow. So this is more of a speculator. It seems more like a speculation play in the long term of things, but within a market that I believe is not speculative. It's a market that I see huge potential growth in the upcoming years. If we take a look at their balance sheet, they right now have about $263 million in debt, and they have about $195 million of cash and short-term investments. To me, this is not that strong, and let me tell you why. Normally, when a company is not profitable, I want them to be able to have enough cash to pay off all their debt at the moment. And that's not the case here for 2U. Right now, they do not have the cash to pretty much pay off all their debt. But then we have to take a look at something else. That debt, how far in advance is that debt? If that debt is not owed within the next 3 years, that's okay, right? Because right now interest is very low, so it's okay to have some form of debt. But that is something investors should definitely take a look at before going into this company. So I mentioned ARK is heavily investing, and we can see ARK right now has 13.5% ownership in this company. They are very, very bullish. All right, so the next company we're going to take a look at is a monster in the gaming world. Everybody knows them, and that is Nintendo. Nintendo right now is, you can trade it over the counters with ticker NTDOY. I might say this, a few brokers might not be able to trade over the counter. I'm not sure if in Robinhood you might be able to trade it. I know in Fidelity I'll be able to, and I just want to let you guys know that. So these are over the counter markets, and that's just so. Let's take a look year to date. Year to date, Nintendo has returned about 32% to investors. Let's take a look at their competitors right now. Their competitor right now, well, not their competitors, but someone in that market would be Activision. And Activision in the past year has returned over 100%, it seems, year to date. Let me just take a quick look at that. 61%. So 61% for Activision, and Nintendo has only returned about 32%. So like I mentioned, this has not made the same amount of noise as the other gaming companies. So is there a hidden gem hidden right here? Hidden gem hiding? Whatever. So let's take a look at the market cap. Right now, Nintendo is worth 6.7 trillion Japanese yenis, I believe it's called. And if we convert that to United States dollar, it's close to 67 billion dollars. I did the math around here. No, closer to 63 billion dollars. And to put it into example, this is Activision right now, who owns Blizzard, who owns Call of Duty, has a market cap of $64 billion. So Nintendo, who I personally believe has a bigger IP than Activision, because it's not, Activision only owns a few games, even though those few games are pretty strong. And let me say this, I am a huge Activision bull. For Nintendo to have a bit less market cap than Activision, that to me also tells me that, hey, there's something happening here, and maybe something we should take a look at. So let's take a look at Nintendo's most recent earnings. So Nintendo recently reported their earnings for the first quarter, and this was August 6th of 2020, so about not even a month ago. And here we can see the overall net sales for this company were up 108% compared to the same time last year. Their net profits were up 541% compared to the same time. So this is right now doing amazing. Unfortunately, due to the whole COVID and everybody staying home, more people are gaming, and Nintendo is one that's making a lot of money out of it. We can see the markets are kind of diversified. They make about 38.1% of their sales comes from Americas, 25 comes from Europe, 24 comes from Japan, 13 comes from other. And here, the $358 billion yen in Japanese yen, I believe, it's broken up into the following. Dedicated video game platforms, which includes hardware, software, any downloadable packages, makes up over 358 billion out of 344 billion out of that 358. So most of it comes from the overall, from their Nintendo Switch and all the softwares within the Nintendo Switch. 13.2 billion, so pretty much the rest of it comes from mobile IP related income. So here are any games in the mobile platform, like Mario Kart Tours right now, make up a huge portion. and not a huge portion, but make up a decent portion, and that portion is up 32% compared to the same time last year. They do have playing cards, but that makes up less than 1% of this company's revenue, so I don't even want to look at it, and that's down 37%. But again, that's almost nothing of this company's total sales. So some of the business highlights here we can see in this graph, and let me zoom in for you guys. Maybe you guys can see better if I zoom in. Hopefully that might be too much, but this is their trend. They have the items. The yellow is the Nintendo Switch. The yellow is the Nintendo Switch Lite. The blue is the Nintendo Switch. This is their biggest seller right now, and this is their software. We can see compared to same time last year, they're selling more Nintendo Switch. The Nintendo Switch Lite is recent to the Nintendo world, so it doesn't have same time last year, but it's almost as big as Q3 of 2020. And Q3 is the holiday season. So that's pretty impressive that they're doing that well. Their softwares are also up pretty big, beating same time last year by over 100%. And a lot of this is actually due to this great game. I honestly don't play it, but I just keep hearing about it. Animal Crossing has sold 10.63 million units since starting. And that to me is just ridiculous how strong this game has been and how much is driving force to this company. Animal Crossing was close to 40% of the company's total software sales in April to June. Just one game. This one game is doing amazingness for Nintendo. The only other platform I really want to talk about, and one I feel is one that's gonna continue to go. We've seen a lot of testing to say how strong the mobile world is. We see it with Activision when they released Call of Duty, and now they're focusing a lot of their IP on the mobile infrastructures like Diablo, and I'm pretty sure they're doing more in the upcoming world. Right now, Nintendo recently did Mario Kart Tour. Mario Kart, when it came out, has been such a huge hit. And Nintendo has so much IP, especially with Mario, that the amount of games that they can release mobile can be crazy. Imagine a Super Smash Bros. Mobile game. This is going to be one that I feel is a market untouched for Nintendo, that they're so, even though they're late to the game, just because they have such strong IP into it, is one they can grow pretty fast if they focus on it, and one I'm very, very bullish on. The other one I'm very bullish is Microsoft, Sony, and most of these are going into cloud gaming, which is pretty much like a Netflix style where they have different types of games in there and you pay a subscription base. Nintendo has all these Pokemon games, all these Mario games that they can do as a software cloud, a cloud gaming that is also potential growth for them. And it's not if they're going to do it. We can see that all the other gaming companies are doing something like this. So it's showing that it's working. So Nintendo, I believe, will eventually move into that market as well, and another potential market for them to grow. So now let's take a look at Nintendo's growth. So Nintendo right now, analysts are actually expecting within the next 3 years to drop down its revenue about 3.3 for the next 3 years on average, to grow its revenue negative 3.3. So it's actually seeing a decline of revenue. And that to me is, I believe, is because Nintendo is one of the few games right now that is not going to release a new system anytime soon. So I believe this does not give a bullish scenario to these analysts that are looking at the company. But like I mentioned, the mobile IP world is one that it's untapped for them. If they ever end up entering the clouding market, it's another untapped market that I believe right now analysts are overseeing all of this. Nintendo right now is a company that's already making money, so that's a great thing. And if we take a look at their balance sheet, they right now are debt free and they have a lot of cash with them with respect to their overall market cap. They currently have 1/6 of the cash and short-term investments compared to their market cap. So they were over about $60 billion worth of market cap. They have over $10 billion of quick cash. So this company can actually do some smart acquisitions coming up. And that to me is really impressive. So These are the two companies. The first one is TU, and the second one was Nintendo. I'm liking both these companies a lot, and these are both that are definitely going to start into my market, entering as tier 3 stocks. And I feel that both of them can actually move up to tier 2 in the me just continuing to add. Again, TU being non-profitable for the upcoming 3 years is something to take a look at. And their balance sheet was not as strong, but they are in a market that I feel is very disruptive. Nintendo, on the other case, is a market that's making money already. They have a strong IP. I believe they have so much potential products that they can release to the market that other gaming companies are doing, so they can say, this is working, so this is where we should go. So I hope you guys enjoyed today's episode. Like always, have a good night, and see you tomorrow.